Good day, I'm Marius Cornelissen. I'm a portfolio manager at PSG Wealth Menlyn. It's time for a quarterly market view. Let's have a look at what news flows shaped the markets over the last few months. Well, first of all, we had the banking crisis unfolding, specifically in March. Silicon Valley Bank, First Republic Bank, Credit Suisse, Deutsche Bank. There were a lot of banks under pressure, but we'll come to that a bit later. Inflation has remained sticky. Inflation doesn't seem to really want to go down in South Africa. US inflation, we've seen it dropping, but inflation in Europe and the UK still remains high, and it's led to central banks increasing interest rates at an even faster rate. We've had Eskom also presenting their fair share of problems, not only here in Pretoria, where we had the pylons falling over and large sections of the city without power over the last week or so, but Eskom in general, with the energy availability factor not being what it is, it's really set the manufacturing and mining sectors of the economy back. And finally, we've had former President Donald Trump indicted in New York and charged as well for falsifying business records. And yes, it's the first time that we've seen a former or sitting US president charged in such a way. Inflation, yeah, I've mentioned it before, but it's remained sticky, especially in South Africa. We've seen the CPI index remaining elevated, but in the US we've seen inflation dropping significantly over the last few months. In the last week or so alone, American inflation came in much lower than what was anticipated. And it seems that despite the fact that the Federal Reserve will continue to hike interest rates, it might be at a slow rate and might soon be coming to an end. South African inflation, like I said, remains high and sticky. One of the main reasons for that over the last few months has unfortunately been the rand. The rand has been under pressure in 2023. After a good period at the end of 2022, where the rand strengthened from about 18.50 to the levels of about 17 rand against the US dollar, since the start of the year, the rand has gone south again. It's gone from the 17 rand levels to as high as 18.50. For the last few days, it's a bit stronger. It's around about 18 rand 10, 18 rand 15, 18 rand 20 levels where it oscillates. But it's significantly weaker than the start of the year, and that's put upward pressure on fuel prices as well as food prices. One of the other things that's really let the rand remain under pressure has been foreign bond holdings, which has also dropped quite a bit. After foreigners initially bought a lot of South African government bonds in January, February and March has seen declines in their holdings of foreign government bonds. In February it was about 25 billion rands that they sold, and there were net sellers as well of 15 billion rands of government bonds in March. Now year to date it's a drop of 11 billion. And what we've seen over the last year or so is that foreigners' holding of South African government bonds has dropped significantly. It's now only about 25% of government bonds that are owned by foreigners. And in March 2018, it was as high as 42% of the bonds were held by foreigners. So a lot of the rand weakness that we've seen over the last few years has been the result also of foreigners disinvesting from South Africa. The grey listing that we've seen as well has not helped matters, and may be one of the main reasons that we've seen the foreigners selling our bonds in February and March. Inflation, yes, inflation leads to higher interest rates, and we can see that this chart shows US and South African interest rates, specifically the Fed fund rate in the US and the repo rate in South Africa over the last 10 years. And you can see clearly from that interest rates in South Africa, especially after that shock 0.5% increase by the Reserve Bank recently, are now higher than they've been over the last 10 years. In fact, the last time interest rates were at these levels were during the global financial crisis in 2008-2009. So rates extremely high at this stage. US rates also increasing. The Fed will probably increase interest rates maybe at least once more. The South African Reserve Bank is also looking at a further rate increase. But yes, inflation is starting to dip. And if we can see that happening in the US, it'll probably flow through to other countries, and we could easily see the rand strengthening a bit, which will put further downward pressure on local inflation. One of the reasons why inflation is dipping has been energy prices. Now, if one goes and looks at the TTF gas futures, that's European gas futures, they've dropped to levels way below anything else we've seen in the last year. And also Brent crude, despite the fact that the oil price has gone up over the last 2 or 3 weeks, the Brent crude oil price is still significantly lower than where it was a year ago. So we've seen dropping energy prices, we've seen lower coal prices, we're seeing lower oil prices. What does that mean for inflation? Well, obviously that will give us some downward pressure on inflation going forward. One of the other main drivers of inflation in the global scene has been higher food prices. And if one looks at the United Nations food index, one could easily see that since April last year, when food prices spiked globally, it's come down significantly and it's dropping on a month-to-month basis. One of the main reasons we haven't seen the full impact of that locally yet has been, of course, Eskom with the manufacturing, and of course the rand being weak. So with us importing some foodstuffs, that's meant that food prices have remained elevated. Load shedding has also not really helped matters, with food manufacturers and agriculture bearing the brunt of that, and of course obviously increasing their costs. Banks have been one of the main stories of the last quarter. Silicon Valley Bank and Credit Suisse have led the way there, but a lot of people are saying, are we looking at the same type of thing that happened in 2008, 2009 of the global financial crisis, Lehman Brothers and Bear Stearns going belly up at that stage? Well, not quite. This is totally different from 2008. What we've seen now isn't really a credit crisis as such. Banks are usually in trouble when they make bad decisions. That means lending money to people who don't pay it back, or interest rates flying up and them, well, not being positioned correctly. Now, Credit Suisse, they've had problems for years. This is not a new thing. They had a big loss last year. That's old news already. They've had losses in a lot of years over the last 5 or 6 or 7 or 8 years. They've had scandals, they've had large loan defaults from big lenders. It was more a question of when, not if, Credit Suisse needed to be taken over. And yes, UBS and the Swiss government came to the party, and now that has been solved. Now, Silicon Valley Bank has been a total different kettle of fish. Silicon Valley Bank had unique issues. For instance, they had large deposits from very few customers. The deposit base grew a lot over the last 2 or 3 years, with some of these big tech firms making a lot of money and putting it in the bank. But because they didn't really have retail customers, it was a very concentrated position. Now, obviously, over the last couple of months, some of these tech companies found it more difficult to get funding because interest rates went up, and they made a lot less money because the economies opened up again. So some of these tech firms started withdrawing large sums to fund their operations and to pay their staff. That money had to come from somewhere. Now, Silicon Valley Bank took those deposits and they made a big decision of putting too much of that into long-term US treasuries. Now, that seemed like easy money a year or 2 or 3 ago. You could get decent yields on US treasuries instead of cash. But of course, interest rates went up, which means the US treasuries they held lost value. Suddenly, they had to sell a significant amount of those treasuries, and unfortunately, they had to sell it at a loss. And suddenly, the deposit base and the whole credit structure seemed not to be positioned correctly. So they were in trouble and they had to be bailed out. Now, this means that a lot of the banking issues we've seen has been concentrated. US and European banks are actually well capitalized at this stage, and they should be fine going forward. What we've seen, however, with this whole situation of Silicon Valley Bank is that some of the banking stocks have gone down quite a bit. Just in March alone, you can see on the chart on the screen, Bank of America dropped a lot. It's down 26% over the last year. Wells Fargo, also one of the major banks, down nearly 20%. And one of the smaller banks, First Republic Bank, had to be bailed out by the Fed and some of the other big banks on Wall Street, and their share price crashed. This, however, is probably one of the few occasions where you'll see some of these small regional banks might still come under pressure going forward. But the large, big players in the US and European banking sector, they're well capitalized, they're well positioned, they should actually make more money from rising interest rates. So their earnings should remain stable going forward. This might in fact be a quite good opportunity to look at some of these offshore banking stocks. Banking crisis? Well, the large US banks are well capitalized. This is the Tier 1 capital ratio at Bank of America, well, since the global financial crisis to now. And you can see that the capital ratio has strengthened from 7.8%, where it was at that stage, to over 13%. Now, this is a very strong capital ratio, and this just means that they are not going to walk the same path as Silicon Valley Bank. Eskom, I think we've seen so much load shedding so far this year, and also 2022, that the dark days of 2021 seem lighter if one looks back at it now. Over the last few years, we've seen that the energy availability factor from Eskom has taken a big hit. In 2020, of course, that was COVID times, the energy availability factor from Eskom was 65%, still below the 75% that they wanted to be, but it seemed to be okay. In 2021, it dropped a bit, and we started seeing load shedding, and in 2022, it dropped quite a lot. And especially in the last quarter of 2022, we saw it dropping to about 55%. 2023 has been even worse, and that's why we've seen this constant load shedding. Now, PwC and also the Bureau for Economic Research at Stellenbosch University said that the SA economy could have grown by close to 7% in 2022 if load shedding was not the stumbling block. Now, economic growth was at 2%, which means it cost our economy about 5% in lost GDP in 2022. So the situation in South Africa regarding our economy, regarding unemployment, could have been a lot better had it not been for the significant level of load shedding. We've also seen Investec coming out and saying they expect SA's real GDP to only grow in 2023 by 0.3%, with a risk of an even lower number due to load shedding. Now, this all is extremely bad for the local economy. What we've seen, for instance, is that retailers are spending a lot of money on diesel just to keep the generators running, to keep the food cold. Shoprite is talking about spending over 1 billion rand in 2023 just to keep everything fresh in the supermarkets. This is a significant issue also for agriculture. It's very difficult to irrigate crops continuously if there's load shedding, and also for manufacturers, this is a huge risk for their earnings and their production going forward. It's always nice looking back, not always easy reading looking back, but this is one of the things I love, is a Smartie box. It looks like a bunch of Smarties, but this is in fact the returns for a lot of local asset classes over the last 10 odd years. And you'll see that in 2014 till 2016, 2017, listed property was a big producer of returns in South Africa. And then of course came 2018 and then the COVID times in 2020. It bounced back a bit from low levels in 2021, but listed property has been poor again in 2022 and year to date. Over the last few years as well, foreign equity usually outperformed. And again, last year, foreign equity didn't do well. We saw the rand strengthening a bit, and we also saw offshore share markets tumbling. A lot of people then said, no, you should move out of foreign equity and not be in it in 2023. The same scenario might play out again. Well, it didn't play out that way. So far, year to date, for the first 3 months till end of March, foreign equity of all the asset classes was the top performer, growing by 12.3%. SA equity for the first 3 months of the year, not too bad, over 5%. So it's just interesting. A lot of people at the start of the year said, go to cash. It's going to be safer there, too much uncertainty in the world. The banking crisis has since unfolded. We've seen tensions between China and Taiwan, the Ukraine wars going on. Everything seems bad, risk of recession in the US. And despite that, the first 3 months of this year has been quite good. And yeah, like I said, foreign equity, which seemed to be like a bad bet for a lot of people this year, has so far been the one that's kept the portfolios up. Yes, I spoke about the US recession. It seems very likely that the US will move into a recession, and in all fairness, if it happens, and it probably will, it'll be short and sweet. We've also seen in previous recessions markets not really going up or bouncing back quite quickly even before the end of the recession, so it's not really something to fear. I think what makes this one a bit different is we've already seen last year markets reacting to a coming recession, because we've been talking about the recession that's looming for the last year or so. In stock markets, the S&P 500, the Nasdaq, the Dow Jones, even European markets, they've all already corrected downwards, so a lot of that has probably been priced in. One of the things I like looking at to see if a recession is likely or not is simply banks and their lending standards. Now, if one looks at this chart, you can see that usually when banks tighten their lending standards for commercial as well as industrial loans to firms, then inevitably there's a recession. Why does that happen? Well, when banks see the economic environment becoming a lot more difficult, they look to be a lot more stringent and don't just lend any money out to anybody without a good idea of them getting a return on that loan. So we've seen that happening in the past. When the banks start tightening, usually we see a recession unfolding. On the right hand side, you can see clearly the banks are tightening their lending standards there, and that could be in anticipation of them knowing that there's some trouble ahead for some firms. Well, we're nearly at the end, so what keeps me awake at night? Yes, we do live in uncertain times. The war in Ukraine is just ongoing. I spoke about the China and Taiwan tensions. One of my big fears remain global central banks could be overshooting of their interest rate hikes. We could already see the inflation in the US coming down quite a bit. The Fed will continue to hike a bit more, but they might hike a bit too much. There's always the fear that the recession, which we expect to be short, could be deeper and longer, but I think with the inflation coming down as it is, that the likelihood of that is becoming less. More on the local scene, corruption is still a scourge in South Africa. Eskom, it's a problem. The water issues as well is becoming even worse than it was, and it's not because the dams aren't full, it's because of the infrastructure, and of course the load shedding means that the reservoirs can't be pumped full. And then of course local political instability, especially in municipal councils. We see this, it is becoming a big problem, and the worry with that is that service delivery will get even worse than it currently is. What gives me hope? There's lots of reasons to be hopeful. The rand should be stronger going forward. Once we see the US rate hikes coming to an end, the rand should strengthen, and most other currencies should strengthen against the US dollar. Fair value of the rand probably around about 16.50. It's not going to go there overnight, but over the coming months we probably should see it moving stronger. A stronger rand will lead to lower petrol prices, lower stable food prices, and we know that inflation is set to moderate. Now, interest rate cuts will start happening maybe at the end of this year or 2024 as recessions in Europe and the US are confirmed. And one must always remember, markets react swiftly to lower interest rates. As the idea of lower interest rates start coming up, markets anticipate that and then they start going up. China is starting their growth engine again. One of the interesting things is that there's a lot of pent-up savings in China. Because they were locked down for a large part over the last 3 years, household deposits increased quite a bit. So households are sitting on a lot of cash in China, and once things open up again, we expect that savings to be used, and that could well drive their economy to higher levels. But at the end of the day, like we've seen with the Smarty Box earlier, Don't always just look back at the past. You must look forward. You must be realistic, and you must diversify. Thank you.